Thank you. Arigato. Minasan Ohio gozaimasu. I'd like to welcome you, and I am honored to be here today. That it means a great deal to me that you would take time out of your life to come listen to what I have to teach you today. I need a the changer and the, oh, I've got it. I have a question for you. Which way is the bus going? How many think the bus is going that way? How many think it's going this way? How many don't know? That bus is like reading a chart. Look at it one more time and see if you can see which way the bus is going. It's interesting because when this test is given to children, 95% answer it correctly because they know the bus is going this way. Why is that? What can they see that we can't see? They know that the door to get into the bus is on the other side of the bus. The windows are on this side of the bus, which doesn't show the door. And that's like looking at charts. You have to really look and think to understand what's on the chart. And what I'll be doing today is showing you how I look at charts and things that I see that hopefully will help you in your own trading and your investment decisions in the market. These are some of the things I've learned in my 50 years of trading. First is the government is right. There's a great deal of risk in trading in the markets. That warning that the government tells you, they're right, they're correct. What I do is risky. There's no easy path to instant wealth trading. In fact, if you came here looking for easy, get-rich-quick money, the doors are there, you should leave. This is hard work and it's really risky. So what the government tells us is correct, your government, my government. I think, though, that we can see the future. We can get a little glimpse of the future from time to time. I'm going to give you one of my glimpses of the future today, several views of the future. And the big difference in the way I trade and most people trade is I think fundamentals matter. So this is critical to me, fundamentals of the marketplace. Please, please take this one lesson home with you today. Charts don't move the markets. Conditions move the markets. Prices go from here to here because of fundamental conditions. They dance around because of technical and emotions of the day, but it's the trend is caused by fundamentals. And if that's true, then wouldn't it help spend more time looking at fundamentals than charts? My next point is that the key to all of this is money management. If you don't know how to manage your money, you will probably lose most, if not all, of your money. Money management is just critical. And trend is extremely important. It is the gravity of the marketplace. How many day traders do we have? How many people day trade? Thank you. How many wish they didn't day trade? Most day traders end up losing money. And there's a formula why that happens. The math is stacked against you, and I will show you that formula later today. One way we can see the future is to look at the seasonal pattern. There's a time period when rice is harvested, wheat is planted, that cause natural cycles in the marketplace. That's one thing we can look at. There are cycles in prices. We'll look at cycles today. I'll show you my cycle work. And I've also found there are repetitive patterns in price. Some of the stuff on some of the charts can help us. Some of those patterns can be of value to us. Now I want to take all of you back into time. To go back to 1905. I don't see anybody that was here that was born in 1905. But that's what happened in 1905. Was that a bull market or was that a bear market? How many think that was a bull market? Bull market, right? Hey, we finally all agree. Anybody think that was a bear market? Nobody. Great. So we can all agree on something in the market. There was 2005 from here up to there. And here's 2015. Here up to there. Bull market? Sure. Absolutely. Again, we all agree. Coming forward another 10 years, we come to 1925. Bull market again. Prices went from here to here. Is there a pattern there? We saw years ending in 1905, 1915, 1925, years ending in 5 were all very, very strong bull markets. What do you think happened in 1935? That would be interesting. Can this trend continue? Well, there's 1935. It begins right here and ends over there. Another rip-roaring bull market. Look at those years ending in 5. We've just found out something that you didn't know 5 minutes ago. 1945. Starts here, ends there. The strategy that we've seen so far in years ending in 5 would be to buy market breaks because years ending in 5 rally. Is that a sensible strategy? If this pattern continues in the future, which we don't know yet, but let's use that as our strategy and move forward to see. It can't always work. Years ending in 5 can't always rally, can they? 1955. Starts here, ends there, by the pullbacks. The original work on this was done by Edgar Lawrence Smith in the 1930s. All I've done is take his work backwards and forwards. I've taken prices in Europe back to the 1700s, back 2 centuries. And what we found is that years ending in 5 are the years most prone to have substantial bull markets. There's 1965, starts here, ends there, buy the breaks in years ending in 5. This decline was caused by the invasion of Vietnam, the Gulf of Tonkin resolution. Market came right back. So what are we going to do in 1975? How many people want to buy in 1975? How many don't want to buy in 1975? How many don't like to raise their hand? The couple. Okay, good. Thank you. Well, let's look at 1975. It starts right here. It ends up there. Bull markets happen in years 5 very consistently. In fact, we can go to 1985, which starts here and ends there. And 1995, which starts here and ends there. Are you a believer yet? So 2005 in the U.S. starts here, buy the breaks, ends there. But all of my stuff, my tools work better in the Japanese market than in the American market. So how about the Nikkei in, oh, did we miss it? In 2015. Oh, I don't have it there. 2015 was 2005 was a rip-roaring bull market for the Nikkei. It just went straight up. Do you recall? Strong? Very strong market. Much stronger than in the United States. So what do you think? 2015? I don't know what you're going to be doing in 2015. At 70 years of age, I just hope, God willing, I'm still alive. And I will be buying stocks. I will mortgage my house and buy stocks. Then I'll get a second mortgage on my house and buy more stocks. And probably get a third mortgage and buy more stocks. Incidentally, if you have questions as I go along, feel free to raise your hand and we can ask questions. If you have a question about anything, not a problem. Feel free to ask questions at any time that you would like to. There are several other cycles that affect stock prices in Japan and America as well I would like to talk to you about now. Stock prices in America have exhibited a very strong pattern, 2-year cycle pattern and a 4-year cycle pattern. We'll look at the 2-year pattern first of all. The 2-year pattern is very interesting. It called for a market rally here, 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 and in the middle of 2013 it calls for a rally. So I have to be alerted to the middle of this year for a market rally of some magnitude. This is not as strong as the 2015 but it's certainly an alert, something I pay attention to. But more important is the 4-year pattern that I uncovered in 1970. So I've been trading this 4-year pattern from 1970. 40 years now, real time. I started trading in 1962. 4 years later, we had a substantial market low in 1966. I noticed that, and in 1970, 4 years after 1966, another market low. That was the observation that I made in 1970. Now here's the amazing thing. If you come forward 4 years from 1970, you get a substantial stock market low in 1974. Add 4 to 74, you get a 1978 low. Add 4 to 78, you got 1982. That was the start of this huge bull market. So the blue line is my 4-year cycle pattern. As you can see, it called for a market low. That was a massive run up to 87, another market low in 90, and another market low in 1994. Incidentally, the chart you're seeing, I'm using TradeStation that is available here in Japan through Monex. Well, let's see how we've done from 1994. If we move forward 4 more years, there was 1994. There's a 4-year cycle low, another year cycle low, another year cycle low, another year cycle low, and look what's happening in the middle of 2014. 4-year low, just prior to 2015 when we would expect a bull market, right? Bull market in 2015. This should represent the ideal buy point as we move into the 2015 bull market. September 2014, about September 15th. I don't know what time zone, but sometime late September, I think will be the start of or the beginnings of the 2015 bull market, where the 2-year, 4-year kick in to 2015. This is the 2013, what's been going on in the market now in America, and to some extent has influenced your market. This is the first year of a president's second term in office. This is President Obama's second, and fortunately, last term as president. Typically, this is what happens in a president's second term in office. First year, we rally into middle of March and then come down. What month are we in now? Does anybody over here know what month we're in? March, right? Good, excellent. Okay, we agree. See, it's pretty simple. Trading the markets is not rocket science. The more complex it is, the more likelihood that it will fail. So my expectation will be a decline until end of May, June. Then we start to rally again. We can take this seasonal view into a much shorter term view of the market to an intraday view. So you day traders, pay attention. This is how the United States stock market, the S&P E-minis, actually have traded on average every Monday and every Tuesday. On average, we've started Sunday nights rallying up until the middle of the session, come down, and have a late in the day rally. So if you're a short-term trader, it would make sense, wouldn't it, to be a buyer early? If you get buy signals, they're probably going to work. Sell signals mid-session are probably going to work because that's how prices have averaged most of the time in the United States of America. What happens here in Japan? Does anybody know? Well, let's find out. This is how prices trade in Japan on average the last 12 years. Monday starts trading to the downside until about the middle of the day. It gets very choppy and then starts a rally into Tuesday. I have broken these roadmaps down for the currencies, for the Japanese yen, for bonds, for all the major markets of the world, so we know intraday when they're most apt to rally or decline, which gives a trader a great insight to know if I get a buy signal in this area, it's probably going to be good. Sell signals there, or a buy signal in there, I'm going to be a little worried about it because most likely it's going to come down. How many trade currencies? Currencies real strong intraday patterns like this. And how many trade gold? Gold, incredibly strong intraday patterns. Gold tends to rally on Fridays most of the time. Starting around mid-session on Fridays, gold rallies. Well, let's talk about cycles. This is where I think some people get confused, and it was confusing to me for quite a while, 20 years trading. Cycles are about time. We bottom here, we should bottom here, we should bottom here, equal distances, whatever their time. They tell us the time of a rally, but not the magnitude of the rally. The magnitude of the rally, how big it's going to be, is caused by the news events of the day. Inflation, deflation, interest rates, money supply, those are things that cause the magnitude. All the cycle does is tell us about when it should happen, but it doesn't tell us the magnitude. They're time dependent, not momentum dependent. And that's very important. You realize the difference. So cycles are all about time more than magnitude. And it seems there are many cycles. There's a 13-week cycle, 56-week cycle. There's a lot of cycles. I combine them all together and put them into one, which I'll show you today. So I combine them. But I like to know why things might work. I don't want just they work isn't good enough. I want to know why things should work. And here's one big reason. The markets are not set up for you. They're not set up for me. We're an after fact. We're speculators. The users and producers of commodities needed a place where they could facilitate and exchange a commodity or a stock. That's why exchanges exist. And we have traditional business cycles, 13 weeks, a quarter of a year. Earnings reports are reported on a quarter of a year basis or a half year basis. That's where the 13-week cycle comes from. It's why it's so strong, especially in the stock market. And this has always puzzled me. How many seasons are there in a year? Anybody have an answer? 4, right? How many weeks in a season? 13. Now, what's always I've found unusual about that, how many suits are there in a deck of cards? Hearts, diamonds, spades, clubs. 4 suits, just like 4 seasons. And how many cards in a suit? 13. And there are 52 cards in a deck of cards, just like there are 52 weeks in a year. And here's the amazing thing. If you count up the pips, those are the dots on cards. The pips, it says 7, there's 7 spades. That's called a pip. You get the same number of pips on a deck of cards as you get the number of days in a year, which proves the stock market is nothing but a deck of cards. Money is made on Main Street and lost on Wall Street. Part of that, be careful. We can avoid some of that by using cycles in the marketplace, traditional business cycles, and monthly government reports. The red line is my cycle forecast for Apple stock. It projects 3 months in advance. This point was known 3 months back here. This low was known back here. So we can get from these cycles some pretty interesting turning points for a commodity or a stock. Here is the price of gold. We'd expect a decline from here to here, rally, and a movement in here based on the projection of what should happen in gold. This point known 3 months in advance. Usually this works really well. We're looking at gold again. A rally here, up to here. This would suggest we would decline, but we actually rallied. So we have a cycle inversion. If prices are rallying when the forecast is down, it says when this reverses, then the market will reverse. This suggests cyclical reversal in the market. Whatever it's doing here, we should reverse. And as you can see, we did. This is crude oil. You can see that usually we're able to get a pretty good idea of when the market will top, when it will bottom, when it will invert itself. And I think I've got some stocks at the bond market, coffee. I thought we had this is the Nikkei. Interesting to me, This is the same formula that you looked at for gold and coffee and crude oil. The same formula for the Nikkei. This is the current forecast. We should start a rally in this time period up to about now, and then come down into May. So that's my view of what I would be looking for to take place in Japanese stock prices. Pretty choppy affair now for March, back and forth, a rally up into May starting mid-April and then down again. That's as far out as I can forecast right now. But isn't it nice to have a view of the future? Here's Sony, the cycle forecast. We should come down. Oh, we did. We should rally up. Wow, Sony had a really strong day yesterday. It's right in phase with the cyclical forecast. How many use TradeStation? How many people use TradeStation? Anybody else use TradeStation? Okay. It is in TradeStation under one of my indicators. So I'm a believer that there are cycles that we can use to get a glimpse of the future for stocks and commodities, as I think I've demonstrated. Well, fundamentals really matter. I'm going to talk a little bit about fundamentals now. Supply and demand, this is huge. Those of you who trade stocks, invest in stocks, here's the difference between stocks and commodities. How long can you live without owning a share of Toyota Motors? All your life. Do you need a share of Apple to survive? Does anyone need a share of Apple to survive? But you need rice, wheat, beans, silk, cotton. We must have those to survive. My point being that we have better supply-demand figures in real commodities than we do in stocks, because we have real production of a commodity and real consumption of a commodity, which we don't have for stock. Another point that's critical to me, and then we're going to take a break for a moment, commercial buying. As I mentioned earlier, these markets were set up for the people that produce or consume a commodity, for the big guys, not us. We're just little speculators. And every Thursday, the United States government reports for free on the internet the long position and the short position of these big superpowers of the world. We call them the commercials. And we know every week how much they've been buying of any commodity and how much they've been selling. I started using that data in 1970. So I'm going to show you in a moment how I use it. I'm not that smart of a guy. I don't have any background in mathematics. I started as an art student in college. I wasn't very good at being an artist, so I eventually got my degree in journalism. And what I saw is the markets are a lot like being a journalist. Finding somebody that knows the story. And the people that know the story are these commercials. The people that grow rice or wheat or corn or soybeans, they know that's their business. So that's informed money. And all I've done is just find who the smart guys are and do what they're doing. You don't have to be very smart to do that. You don't have to be complex mathematician to just find the smart guys and do what they're doing. Some of you have my books. How many people have bought one of my books? I appreciate that very much, and I want you to know that the royalties for those books go for scholarships where I went to school. So you've helped put a lot of kids through college, and they and I thank you for doing that. And those who have books, I will be at the Pan Rolling Book booth, which I think is back here, and I will autograph books for you at the end of this presentation, or pictures. We can do that at the Pan Rolling booth. Get to see old friends as well. Well, let me explain commercial buying to you. It's really simple. The red line up there, that's the net long position of the commercials. When it's real high, they've been buying. When it's real low, they've been selling. It's just that simple. This is Treasury bonds. Real high, they've been buying. Wow, prices rally. Real high in here, prices rally. High here, prices rally. That's about $30,000 per contract. Almost $40,000 from here to here. Some magnitude of these moves. This was the largest net long position for over a year. Relatively bullish. prices rallied. To make this a little simpler, I placed this, they're buying and selling into an index. This way we can see when they are relatively higher or relatively lower on a standardized basis. We're looking at gold here. Notice when my commercial index is very high, most of the time we rally. In other words, what you now can know is when a market is set up to rally. So you don't have to rely on technical stuff anymore. You can rely on fundamentals, what smart money is doing versus what you're thinking or dreaming of. You now know when big guys are buying, you can be buying right along with them. Now the opposite side of the commercials are a group of people that's really horrible. They're bad. They're losing most of the time in the markets. Who could that group be? It's you and you and you and you and you and you. It's the public. The government also tells us each week what the public is doing in the marketplace. And that's the green line that you see here. And when the public is very bearish, this line is low. When it's very low, look what happens. Prices almost always rally when the public is very negative. The public almost always does the wrong thing. But I found a group that's even worse than the public. The advisors. Each week we measure the number of newsletters, brokerage firms, websites that are bullish or bearish. This is a weekly chart of soybean oil. On this week, 80% of the advisors were bullish. The next week, the market topped. On this week, over 90% of the advisors were saying buy soybean oil, sending out emails saying buy soybean oil, and it went down. Extremely high readings of bullishness. There's one that doesn't work, but for the most part, set up significant declines in the marketplace. And when they're very bearish, they don't want to buy. We're close to a market low. We do this every week for all futures and most all stocks, including the active traded stocks in Japan that trade also in America. This is Microsoft. Again, when everybody's bearish, we tend to rally in the market. But look at that. Everyone's really bearish on Microsoft, big rally. Everyone's really bullish, we decline. So if we can tell the smart money is, and I think we've demonstrated we can do that, and we know who the dumb money is, we can show you how to tell that, the advisors. When the advisors are really bullish and the commercials are really bearish, that's the ideal setup in a marketplace. 1 week from the all-time high on Microsoft, the advisors were 95% bullish. The next week, the ultimate all-time high on Microsoft was hit. What I like about my work is it's pretty simple. Either they're very bullish or they're very bearish, right? That's not too hard to tell. Now I'm going to take you into the world of stocks and let you know, this is Japan, if I know how the commercials buy commodities because I've studied these people since 1970. I can then also tell how they would buy stocks if they were in the stock market. They buy differently than you and I. I have a formula that shows us how they buy. So the basic rule, I'm going to go slow on this. If I go too fast, let me know. When the commercials are bullish, we're above the green line. So here's the rule. When the red line is above the green line, buy. Was that too fast? Okay. When the red line is below the red line, here's Microsoft, a stock. When the red line is above the green line, look for a buy. Everybody in this room, I hope, is going to agree the red line is below the red line, look for a sell. This is not like Elliott Wave or astrology or W.D. Gann or Fibonacci. The line is above the line or is below the line. It's just that simple. Hey, how many people know why we use the term bullish for an up market? Does anybody know where the phrase bullish came from? I'm going to teach you. This is a great story. Mark Twain, the American humorist and author, was living in California during the mining days, gold mining days. And instead of having boxing matches like we have now, they had a bull fight a bear until the bull killed the bear or the bear killed the bull. And Mark Twain wrote about the stock market had been coming down, and he noticed in the fight of the bull and the bear took his paw and went whoosh down on the bull. And he said, the bears have been on Wall Street knocking prices down. A bull comes down with his horns and up into the bear. So now you know where these terms bullish and bearish come from. From Mark Twain's analogy of the bull and the bear fight and stock prices. So another technique that I use is to look for accumulation in the marketplace. The green line you see up here is the actual buying of insiders in the market. Notice in 2009, we went to new low in prices, closing lower here than here. But the green line measure of actual accumulation of money really in the market showed divergence. New low in price, but accumulation is much stronger than this decline, very bullish. And again, this is the same formula that I use in the United States on stocks and futures that we're using here in Japan. Look at the big divergence. Price looks really good, but we have massive distribution in the market and it comes down. This is the price of gold. Gold made a new closing high in price up there. It looks really bullish. But the insiders were getting out of the market. See how they didn't buy any at all in this rally and prices fell apart. We can get an inside view, an X-ray view of price action when we look at accumulation in the marketplace. Just like that school bus, you didn't know which way it was going because you didn't think of looking on the other side of the bus to see where the door is the school kids get into the bus. Price itself is very deceptive. I'm very careful with price. So I want to look at the underpinnings, the foundation of what causes or supports price movement, and in my world, that's accumulation in the marketplace. Here's another example in our markets here in Japan. You can see accumulation is much stronger than price. New low in price, not an accumulation. Lo and behold, away goes the Japanese stock market. I believe there's smart money operating in the markets. That's my basic belief. And I haven't asked this question before. I'm really curious, how many of you here in Japan think that there's insiders in the market, smart money, that are buying and selling? How many think that? We commonly agree that some guys are smarter than us, right? And that people do maybe not manipulate things, but they understand it better than we do. So all we have to do is figure out what they're doing, measure their accumulation, and we can succeed because now we know what they know. Here's the most exciting thing I can tell you about what I do in trading. I've made millions of dollars trading. Not once, not twice, not 3 times, numerous times. Real trading, real money. But the fact I can do it only means maybe I'm talented or maybe I'm a little lucky every now and then. The better news is that you can learn to do this. This is the World Cup of commodity trading. It's the World Championship. These are the winners, 2008, 9, and 10. My student, my student, my student, my student, my student, my student. That's the thing I'm the happiest about, is not that I can make money, but that I've been able to share this knowledge, the little bit that I have, with other people who've gone on to some great successes. 2011, there's my students again. Chris, Kurt, Josh, and Melinda Brunei. Josh just started trading with me 6 months later. He was 5th place in the World Cup Trading Championship. Here's 2013. My student, my student, my student, my student. Brady Preston's a great one. He's going to go on to greatness as a money manager. 2012, Andrea, up 82%. He's an Italian, barely speaks English. Came to learn. Now he's one of the great traders in Europe. I'd like to share some other information with you about possible trading strategies. It's a common belief that there's a lot of money to be made following trends, trend following. And that's kind of true, but last year, the trend followers didn't do so well. This is the actual results of the world's largest trend following funds. And last year, we see year to date, lost money, made a little bit, lost, made, lost, little bit, lost. The trend followers often don't do well at all for a year or 2 years. Clearly, trend following works, but you have to have $800,000 or more and a lot of time and a lot of patience, which means most everybody in this room is not qualified. We probably need a little shorter term approach in the market. Now, the way that my students won those trading championships, the way I won the trading championship, the way my 16-year-old daughter won the trading championship, is largely because of how we managed our money. I took my $10,000 to $1.1 million in a year. What you may not have heard, the equity high was $2.2 million. $10,000 went to $2.2 million, and then in the crash of 1987, the $2.2 million came down to $700,000. I was in Africa on a safari during the crash. I came back and traded the $700,000 back to $1.1 million in the month of November and December. It was about an 80% gain in 2 months. That's because to win these trading championships, we use a very aggressive form of money management. You have to be good in the markets, and you have to really press your advantage with money management. So I'm going to give you today the ultimate formula for money management, which is E equals MC squared from Albert Einstein. You didn't know Einstein was a commodity trader. He left us this formula. Have any of you ever felt emotional when you're trading? Anybody? Of course, it's very emotional, isn't it? Look at all the hands go up finally. We all say yes. I have news for you. It's not because of the market. It's about you. Your mental state, your mind, is where it all begins. Your mind creates those emotions, and the emotions are what get you off of successful trading. You get too emotional, you cannot take correct action. Which gets back to the question of why do we get so emotional? Somebody that doesn't follow the stock market doesn't get emotional if the Nikkei goes up 5,000 points or goes down 100,000 points. It doesn't bother them. So the markets are not inherently emotional. What makes them emotional is when we bet on them. And if you bet 1 penny on the Nikkei, you won't be as emotional as somebody that bets $100 million on the Nikkei. Would that make sense? So this is the formula Einstein left us with. C squared is the number of contracts or position you have in the market. M is based on the money in your account. Imagine somebody that has $10,000 and he has 10 positions on, which means he could wipe out all of his money in 5 minutes, versus somebody who has $1 million in his account and has one position that might lose $1,000. Who's going to be the most emotional? That's what E stands for. Your emotions are a function of the money you have and the size of your position. So if you're too emotional in the market, it's got nothing to do with the market. It's all about you, and your bet is too big for your emotions. So there's no ultimate be-all, one formula fits everybody, because his emotions or her emotions may be different than my emotions. You have to find that level where you say, if I lose that much money, fine, I can accept it. I don't like it, but I can sleep at night. My wife won't shoot me, won't leave me. Then you will be an emotionally healthy trader, and your success will be much more apt to come. So to control your emotions, just control the size of your bet. That's all you have to do. Now here's some general ideas of risk factors, how much of your money you can risk on a trade. And here's the problems. If you risk 10% of your money on every trade, so if I have $10,000 in my account, I can lose $1,000. That's a 10% bet. If I have 4 losing trades in a row, I'm going to lose 34% of my money in just 4 losing trades. And anybody that trades has had 4 losing trades in a row. I have had it, you've had it, we've all had it. But if you're going to be aggressive, you want to win those trading championships, you're going for broke, you're going to have about a 10% risk factor. That's what my students have done that have achieved those phenomenal results that you saw. But your chance of ruin is significantly higher. The second highest gain in those trading championships is by another one of my students. A young girl that took $10,000 to $110,000 real-time, real trading. That was my daughter, who is here in Tokyo in her movie called The Great and Powerful Oz. I don't know if anybody, has anybody seen The Great and Powerful Oz, the movie yet? Nobody's seen it. They're all looking at charts. Well, you'll enjoy the movie. It's in 3D. It's an amazing movie. But to win trading championships, that's the type of risk you have to take. My risk factor is more like down to here, 2%. Because if I do get 4 losers in a row, I'm still in the game. I'm only down 8%. So you really have to tailor where you, can you live with a 12% drawdown, 15, 20% drawdown? You have to find that number for you. I can't tell it to you. It's not a formula that fits all of us. My shoes won't fit him. My son is a psychiatrist trained at Johns Hopkins in the United States. Jason did an interview, a psychological personality profile of some of the best traders ever. His findings are in a book published by McGraw-Hill. And what he found is that there's a significant difference in these very successful traders and some things they all share in common. Here are 2 of them. First of all, they all had to find a strategy that fit them. Some were mechanical trend followers because that fit their personality to go to-tune, to-tune, to-tune. They could use a mechanical system. Others were a little more creative. They looked at things and decided what to do and bought or sold without a mechanical system. But when the people that were, let's call it creative traders, tried a mechanical system, even though it worked, it didn't work for them. It didn't fit their personality. So you have to find the strategy that fits you. That's the first thing. And here was the other really interesting thing Jason found. Fascinating. Right across the board, whether these traders were male or female, Chinese, Japanese, Europeans, or Americans, they all shared one personality quirk. All of them were a little unsure of themselves. All of them felt they weren't good enough. And that's probably why they're really good traders. They all had a low level of confidence. And that was really surprising because you'd think these people have made billions of dollars in some cases, would have a high level of confidence. But when you think about his findings, what we recognize is these great traders are great in part because they're not overconfident, so they don't risk much. They don't bet big, and if they're wrong, they get out. Confidence kills in this business. Because if you're really confident about your position and you're wrong, well, you're wrong. You're Mr. Confident. You're Tony Robbins. You're all Mr. Powerful. And you hold it all the way down and lose a lot of money. But if you're not very confident, you're kind of frightened. You really don't know if this trade's going to work or not, and it's moving against you. You're probably going to say, I'm wrong, again, and get out of it. Well, here's the bottom line of money management as I understand it. Can you see that in the back? It says, bet small. Don't bet big. If you bet big, when you lose, you will lose big. If you bet small and you lose, you will lose small. So we can help stack the advantage in our favor with money management. If you would like a money management app for those that have iPhones, you can go to this website and download it. It's free. It explains my money management strategies. It gives you a calculator. You can calculate your positions. It'll tell you how many contracts or shares to buy. So if you write that down, it's free. You can have it. We hope you'll enjoy it. And I've already seen it on phones here in Japan, so I know it works here. But it works for 5? Okay. So there's a whole lot of information you can put on your phone. Put your trades in there, follow your trades, enjoy it. I think you're going to enjoy it. www.lwucalc.com. And the price is right, free. Most people like free. There's no charge for it. Okay, the law of trends is a law of gravity in our world. In fact, this is one of the most important lessons I've had to learn. Trend is a function of time, and all profits come from trend. No trend, no profits. If markets are perfectly flat, you cannot make money. You need an uptrend, you need a downtrend, there's no money to be made. And here's the good news, is that trend, we know what trend is caused by time. Trend is a function of time. The more time you're in a trade, the more of a trend you can capture. That's not my opinion. That's pure, solid mathematics. And that's the problem day traders, Forex, in and out traders have. They have no time in their favor. It's no wonder 95% of them lose. How can you catch a big trend move in 4 or 5 hours compared to a trend move I can catch in 15, 20 days? Who's got the deck stacked in their favor to catch a trend move? I do, you don't. Plus this in-out trading. Oh my gosh, it's hard work. I'm 71 years old this year. I don't need another trade. I just need another $1 million. I want low-hanging fruit. I don't have to climb to the top of the tree. Maybe the ladder breaks. Maybe the tree breaks and I fall to the ground where I can pick up a bigger, riper apple right in front of me. So if you want to learn how to catch the low-hanging fruit, join me. Admittedly, it's more exciting to day trade. But admittedly, we're not supposed to be in this business for excitement. I think we're here to make money. So that's why I prefer finding markets that are set up. I actually have 6 major setup tools. You saw a couple of them today. Then I have entry techniques, when to get into a trade. 6 or 7 different entry techniques. Then when to get out. Trailing stops, targets. You need all those things. So in my world of trading, I need a setup, a condition why the market will rally. Then once it's set up to rally or decline, I have 5 different techniques that will say buy now, today, at this precise price. Then once I'm in, the problems begin. So then I have to have a target where prices should go, an initial stop loss where I admit defeat and say I'm wrong, and then a mechanical trailing stop so as the market rallies, I can try to stay in that trend. And that's the way I trade, even on a shorter term basis. I'm still looking for conditions, setups, entries, exits. That's what I'll be teaching Tuesday and Wednesday, Hero?
Wednesday, Thursday.
Wednesday, Thursday, I'll be teaching people here how I do this. So they'll be able to learn how I actually trade. I'll be trading your markets as well as ours. There are only 2 types of trading, trend following and anti-trend. And you can define which of those you are. And you can get a sense of trend by looking at accumulation. When Apple topped out last September, October, made a new high in price, but we know that's deceptive. There was no accumulation on that rally, was there? There's no wonder it declined. So these trend signals should have been better. Same thing here. New high in price, no accumulation on the rally. That should be a better trend change. The price you get above, say, a 20-day moving average doesn't tell us how far it will go, how bullish it is. It just says a change in trend, that's all. But the fact that accumulation is stronger than price, as it was also here, price makes a low here, accumulation doesn't. Any trend buy signal here is going to be stronger because we see the smart money, the big guys, have come in. They've begun buying Apple. This is the bond market. Again, you see how the bond market rallies to a new high, but we don't see it in accumulation. New lows in price, not accumulation. That's bullish. Again, bullish. Well, here's a lesson in technical analysis for those of you that keep indicators and charts. You're looking at two indicators up there. One is my percent R, Williams percent R, one I developed in 1966. The other one is my good buddy John Bollinger. Bollinger blue bands, or percent B, are in blue. They look just the same, don't they? Most people have too many indicators on their charts. All these indicators tell you the same thing. It doesn't matter if it's my percent R, Bollinger's B bands, MACD, RSI. They all say the same message. It's about having fewer, not more, indicators on your charts. We were in Singapore a week and a half ago, and someone showed me his computer and his chart screen. He had 15 indicators. You just add to the confusion. That's why I like it. Blue line is above the red line, or it's below the green line. That's it. I mean, that's complex enough for me. I told you this was a tough game to make money at when we started, and it still is true. The quants are the people that have all those degrees in mathematics, and they have algorithms that are automatically trading the market. Actually, last year, they didn't do so good. They lost 3.4% of the money. In 2011, they lost almost 8%. So I hope what I've done today is open some doors, show you some things you haven't thought about, show you when we're going to have the next major bull market, give you some thoughts about how you can improve your trading. If I've done that, it's been a huge successful day for me. You can see more at our website. And I'd like to thank you very much for being here. Good luck and good trading to all of you. Thank you very much. Obrigado. Thank you.